Hello students, in the last videos we have discussed about accounting standard 16, that is property, plant and equipment, right? So let us study about IAS 38, that is intangible asset, one more asset based standard, that is Indian accounting standard 38 intangible assets. So this standard will discuss about the accounting treatment for intangible assets. So it discusses about recognition of intangible assets, measurement and disclosure requirements. So let us understand the objective of this standard. The objective of this standard is to prescribe the accounting treatment for intangible assets. So that are not dealt with specifically is another standard. The standard requires an entity to recognize an intangible asset if and only if standard criteria are met. So the standard specifies the requirements of recognition, measurement and disclosure of intangible assets. The standard states that intangible assets are initially measured at cost and subsequently measured at cost or using the revaluation model. If we talk about scope of this standard, all entities should apply this standard for accounting intangible assets. Some intangible assets that are covered by another accounting standard, that is when specific standard exists for any intangible asset, one should follow the respective standard but not this standard. Take for example goodwill arising on business combinations, so this one is dealt by Indian accounting standard 103, or else intangible assets held for sale in ordinary course of business, this one is dealt by Indian accounting standard 2, right? And also deferred tax assets, that is dealt by Indian accounting standard 12. Before that, let us understand the meaning of intangible assets. So this an intangible asset is an identifiable non-monetary asset without physical substance. It is an identifiable non-monetary asset without physical substance. So if an asset has above 4 features, then it is recognized as intangible asset. That is 4 features means first one, it should be a identifiable, right? And first feature, and second feature, it should be a non-monetary, and third feature, it should be an asset, and fourth one is without physical substance. If any asset has above 4 features, then it is recognized as a intangible asset. So if it does not satisfy such expenditure, will be charged to the statement of profit and loss account. So let us discuss each of the points in detail. First feature is identifiable. So first one, identifiable. So here intangible asset can be termed as identifiable when it is clearly distinguishable from goodwill, that is when it is separable from goodwill, right? Understood? So this intangible asset can be termed as identifiable when it is clearly distinguishable from goodwill. So it is always separable from goodwill, and goodwill arising from business combination is recognized as an asset as it gives future economic benefits from the other assets and synergy benefits from business combinations. As an asset can be said as separable, right? So when it is capable of being sold, licensed, rented and exchanged it with another asset independently without disposal of other assets, or else which is arising from contractual or legal rights. In this case, it need not be separable or transferable. Say the entity received fishing rights from the government, which cannot be transferable, still it can be treated as an intangible asset. So this is the first feature out of 4 features. First is it is an identifiable, right? And second one, non-monetary assets. So non-monetary asset is an asset which is not a monetary asset. Non-monetary asset which is not measured in money, that is called non-monetary asset. And third one, monetary asset. What is this monetary assets? The monetary assets means the following are monetary assets. That is first one, money held, that is we call a monetary asset, right? And assets to be received in amounts of money and which are fixed or determinable, that is ascertainable, these are called monetary assets, right? And one more feature is without physical substance. Intangible assets should not have physical substance. However, some intangible assets may be contained in or on a physical substance, such as a compact disk. So it is in the case of computer software, or else legal documentation. It is in the case of license or patent, or film in the case of motion pictures. So the container value is usually immaterial, even though the container has a physical substance. Its value is commonly treated as a part of the intangible assets that is included in the cost of intangible asset. And in case of some assets, an asset incorporates both intangible and tangible elements. The entity should apply professional judgment to access which element is predominant or significant. For example, computer software for a computer controlled machine tool that cannot operate without that specific software, right? So is an integral part of the related software or hardware that cannot be separated, and it is treated as property, plant and equipment as per Indian Accounting Standard 16. The same applies to the operating system of a computer. When the software is not an integral part of the related hardware, computer software is treated as an intangible asset in this standard. That's why that compact disk or these are what intangible assets. Next, we'll discuss about control. What is this control? An entity which controls as an asset if the entity has the power to obtain the future economic benefits flowing from the underlying resource and to restrict the access of others to those benefits. This power would normally arise from legal rights that are enforceable in a court of law, such as copyrights, licenses, patents, franchisee, etc. So the future economic benefits, which includes revenue from sale of goods, services, cost savings or other benefits from using the assets. In the absence of these legal rights, it is more difficult to demonstrate control, right? However, legal enforceability of a right is not a necessary condition for control, because an entity may be able to control the future economic benefits in some other way. Let me give you an example. One example: Indu Limited, which purchased a chip and operating system for its server for rupees 20 lakh and 5 lakh respectively. A computer chip has both tangible and intangible elements in it, right? So the accountant of the company does not have great knowledge in accounting standards. So why can't you guide him? So this is a small concept capsule of this. What is the suggested answer for this? So as per Indian Accounting Standard 38, that is when an asset contains both tangible and intangible elements which are not separable, right? So professional judgment is required to access which element is predominant. So if tangible element is predominant, it should be treated as a fixed asset as per Indian Accounting Standard 16. So subject to fixed asset definition. So this computer chip is an tangible item, and it cannot work without specific software. Software is an integral part of hardware that is in its it is not separable, right? So generally hardware is a predominant in a chip. So as hardware is a predominant compared to software, so it is appropriate to treat the asset as a property, plant and equipment as per Indian Accounting Standard. So an operating system is mere software, and it is not an integral part of any hardware, so it should be treated as an intangible asset as per Indian Accounting Standard 38. I hope this one is clear, right? So this is about a small concept of Indian Accounting Standard 38, intangible assets. If you have any doubts, you can clarify it. Thank you.